Hi there, I'm Katie Kneidermire with American Pacific Mortgage, and this first-time homebuyer video is all about interest rates, what you need to know that goes into the interest rate that you can get. So first off, just want to start with, this is actually my partner Karen, also my mom, and we work together on all of our files, and she has pretty much taught me everything I know in the business. So let's get right into rates. These are a lot of the things that we tend to hear about interest rates. What are rates today? You know, I heard I can get this rate from the radio, or they read something that says they can get a certain rate. My neighbor told me, I read I can get, etc. So this is really common. And the tough thing is that we need a lot of information in order to really quote an accurate rate. So how do we teach about rates? First off, the market and the economy have a lot to do with where interest rates fall. For instance, right now we're dealing with COVID, which is definitely affecting our economy. And so in order to stimulate the economy, we keep rates low. Stocks and bonds and treasuries also have an impact. So it's just something to understand that it's not lenders, banks, just creating a number. There's a lot of things that go into the interest rate. The biggest thing that we teach our clients about is the number two, which are loan level pricing adjustments. The term itself is not that important, but it's important to understand that there are a lot of different things about each scenario that make the rate your rate. So for instance, the property type, a single family home versus a condo versus maybe a duplex, all of those things can have an impact on the rate. Your credit score, this is a big one that we hear a lot about. So basically we're gonna go into the different indicators of the rate that you're gonna get. So this is all the information that we need to get give an accurate interest rate. And there's even more. So the loan amount, right? A loan that's $200,000 versus $500,000 versus $1 million can all have a different interest rate. The property value. So the property value compared to that loan amount can have a big impact. Maybe you have 5% that you're putting down, or 10%, or 20%, or maybe in a refinance, someone has 50% equity in their property, which means the loan at $400,000 to an $800,000 loan amount, right? That ratio can have an impact on the rate. The purpose, a purchase versus a refinance can often hold a different rate. Your credit score, again, this is one that most people think about. The better your credit score, typically the lower your rate can get. DTI, debt to income. So when we use your income and your debts to qualify you, that ratio can have an impact on the rate. Occupancy. So if someone's buying a home that they're going to live in, right, as their home, which is their primary residence, versus buying an investment property, those rates carry, very differently. We already talked about property and county. And even beyond that, the type of loan. So there are many different loan programs, and those can have a big impact, right? The type of loan, the term, is it a 30-year, is it a 15-year, and an ARM versus a fixed? We don't really need to go into all those right now, but just basically the understanding is that there are a lot of different factors that go into getting a rate. So the other thing I want to teach about is there's a cost associated to rates. So it can be that they have a credit or they can have a cost. Sometimes they're par, which means there's no credit or cost associated. But when I run pricing in my company, this is what comes up, okay? We've selected a 30-year conforming conventional loan. The rates are on the left side, and then you'll see I circled premium cost. And the premium cost is either the cost or the credit that's associated with that rate. So at a 2.9% rate, there would be a $35 credit toward the client. Now at 2.875, there would be a cost of $2,230. Now people they'll often ask, can I get a rate of 2.75? Well, sure, but there's a cost associated, so it's really important to understand that. Here are a few examples that I want to share. So we had a client who was refinancing. Their current balance was at 512. Now I mentioned earlier about there is a the loan amount can have an impact on the rate. So in this case, their balance was 512, their rate was 4.875. They're definitely going to save money by doing a refinance. But you can see on the left side, at a conventional loan of under 510, of a loan amount of 510, their rate was 3.25. That was what I quoted them. However, at that loan amount that their current loan was at 512, the rate would have been 4.25, much higher. So they came in with a little bit extra cash in order to refinance and get a lower rate. And it made a really big difference for them. Now, another client, these are first-time home buyers, they have a current credit score of 680. Now, we're in a planning process, which is great because it enables us to really work on their credit. Right now, if they were to get into a loan of $500,000, you can see the rate would be either 3.5 or 3.3, and there's a cost associated or a credit, right, with both of those. Now, if they got their credit score just to 700, that would make it so they have less of a cost and more of a credit, which would be great. But if they get up to 750, their rate goes down significantly. So it's important to know that at different times, credit can impact more on the rate, but typically it does have a big impact. All right, here's another client. They also were refinancing. This is a situation where the loan to value, okay, their equity in the property had a big impact on the rate. And I shouldn't say big impact, but it had an impact enough, to kind of change the numbers. So if you see on the left side, we estimated that their home value is at 490. They had a loan amount of 412. And so the equity in the home is 16%. Okay, their loan is 84% of the value. Well, they would have had mortgage insurance, which mortgage insurance is an extra insurance taken out by the lender to insure them, and the borrower is paying it. But they still would have had a savings of $296 a month at a rate of 3.375, which is what we locked them in at. Now, and when we say lock, we mean we lock the rate on that day, and that's the rate that they get. Well, when we got the property appraised, the property actually came in higher, which is great, except it changed the rate to 3.5. So even though we'd already locked in, we had to adjust the value, the interest rate up because something changed in the scenario. Now, there wasn't mortgage insurance anymore because we typically only have mortgage insurance up to 80%. So they still had greater savings without that mortgage insurance, but the rate changed. That's the most important thing to understand. And then lastly, here was a client that was a first-time home buyer. And this is a really big one when we talk about the cost and the credit associated with your rate. So these borrowers didn't have a lot of cash to close, okay? They were pretty tight on money. They had their down payment, but closing cost-wise, and that's a whole nother video I've done on closing costs that are associated with purchasing a home. So in this case, the rate would have been, they could have got a rate of about 2.875, but it would have cost them about $500. But instead, we put the rate up to 3.25, and it generated a credit for them of almost $3,000. So it covered about half of their closing costs. So that's just another thing to understand when it comes to purchasing. And actually, that was client D, but it says client C. All right, so they chose that cash to close, which helped them generate a credit. So recap, biggest thing to understand is you can't just ask what a rate is without giving a lot of information, and to be most accurate, pulling credit. So it's great to get a generalization, sure, but it's not accurate. And then the other thing is understanding that rates come with a cost or a credit associated. It can really help you in closing to generate a credit. Most people want to buy down the rate in order for them to get a lower rate, so they're paying less interest over the loan term. But it's definitely something to understand. So hopefully you learned something, and I appreciate your time.